Good afternoon and welcome to the second edition of the weekly market video with Bill Cubard. Thanks for joining us, Bill. Let's start off with, so I know you're a big believer that cable's too high at the moment.
Yes.
What's going to happen with that?
Well, I think one of the things, and this probably goes along with the conjunction about, as we saw earlier this week, with UK inflation finally after 4 years is at 2%. You know, as we also have seen, you know, we're looking at record lows for inflation in the Eurozone. And one of the things where it really came to fruition yesterday when I think the new chief financial officer of Burberry saying, you know, wait a minute, with cable at this kind of level, it's going to be very difficult exporting. And, you know, they basically, and she was just inferring that we could probably have to write down sales by as much as $5 billion because it's very expensive.
So any companies with a lot of exposure to overseas markets
Yes.
are going to find shifting their product, whatever that may be, at that kind of rate very difficult.
Very, very much.
So that's bad news for the FTSE. Because FTSE 100 is exposed to
But remember, 77% of the FTSE companies, so that's the FTSE 100, so if it's, that'd be 77 companies, you know, basically make more than 50% of their earnings overseas, okay? So it's a situation where we've seen with, you know, all the G3, 5, 7, 10, 20, you know, conferences have always been yelling and screaming at the US Federal Reserve / Treasury about a weak dollar, where you see what it's done to the recovery of the United States.
And so over the last, since the start of the year, we've seen the FTSE, well, nothing's been going up, but I mean, it's outperformed other world indices.
Yes.
Because the sterling dollar rate has come off a little bit.
Yes, and I mean, even if it came off to 160, 159, 158, and my talk probably in the next 6 months toward the end of this year is probably in the high 150s, because again, what it will do by having it at a lower rate will keep the rate of inflation down here. And it's one of the things by doing that, you see, that conversely helps the situation with the Bank of England. And I think one of the things where maybe we saw it at 164, 165 towards the end of last year, I mean, there were people out there implying that we would have a rate hike here in the UK in the fourth quarter of, quote, this year.
Right, okay, so we're just getting into the thick of earnings season, particularly in the US. How's that all panning out? We started off nicely?
Yeah, well, it started off nicely, but everybody knows that it's going to be a situation where we're going to see a move from PE ratios and EBITDA, which I think is a communist front organization, but that just shows you how much I know about equities. But I think one of the things that we'll start to see is the amount of cash, not only in the US, but in corporations globally. Now will that stuff start being used for, quote, growth, okay? And I think anybody that feels, that we'll have the same kind of return this year, I don't care what indices, okay, that you look at, because even now we're going to be seeing 6-year highs in most of the European indices. Yesterday at the close, again, another record high for Wall Street. So it's really going to be a situation where clients will either look at different segments of the market. I mean, one of the stocks here in the UK that's done extremely well just in the past 2 or 3 weeks has been African Barrack Gold, just for the simple fact it was beat down so much. So people were looking to say, move that. I mean, move from like 149 to 195. Well, that's a heck of a move, you know, when the price of gold is going down. But these were stocks that had been brutally beaten down in 2011 and 2012. So people are looking to do with that. But also, I think you're going to start seeing not so much penny shares, but stocks that are involved with fracking. Anything that's home building related here in the UK. More the peripherals rather than the Barclay Homes or the Persimons, who've already seen a very nice run in the past, say, 2.5 years, on the assumption that housing was going to lead the market here in on the globe, the UK recovery, which we've seen, which has.
Understood. The banks, UK banks, have started very nicely as well. They're all up based on all sorts of forecasts. You know, are they well placed up there?
Oh, very much so. I mean, what you started to see was in the second half of last year, you started to see move into financial. For the simple fact is, wait a minute, you know, there were only a few lunatics in this country that were feeling that the Bank of England could start raising rates in 2014. Most people feel we will not see any move in rates, okay, until 2015-ish, on and on and on. I mean, like today, you know, with the Aussie dollar, we saw Australian unemployment. I guess I thought papers like the States, we saw a very weak number there. Okay, I don't need to tell you or anybody else. A polar vortex. than what it did the non-farm payrolls last week. But I mean, this is going to be a situation where you're going to see interest-related stocks moving, okay? And I mean, I know Goldman Sachs had a slight hiccup, but I mean, look at Bank of America earlier this week. You know, Bank of America, Merrill Lynch. You know, and these are companies that have had to put billions of dollars, billions of pounds, billions of whatever, you know, in lieu of slight problems with. Have you seen the FX rate? Have you seen what's happening with LIBOR? So I mean, once these are paid off, and if you look at the balance sheet, these companies have made allocations. There is cash available, whether it's 1.2 billion, 1.3 billion. The money is there to be sent to whichever treasury is finding them.
Understood. Okay, great. Let's go back to inflation.
Sorry, it must be the altitude.
No, well, there's a little bit of there's 2% inflation in the UK, which we found out.
Let me back up, okay? October 1979, when I was just a youngster in the United States, okay? Annual inflation at that time was running at 28.9%. That's inflation. 2% isn't. And which way is it going? It's going consecutively down, down, and down. I mean, the people now talking 1.7, 1.5, like when the university stuff. And also the simple fact is, if you've been to the petrol station recently, okay, petrol prices will continue to go down during the course of this year.
But why, what I want to ask is why is a small amount of inflation good, as opposed to, I mean, in Europe they're having big issues because they haven't got enough inflation.
Exactly.
Why is that 2% level something that we'll want to have?
Well, it's a meaningless number, okay? It's sort of like asking me what I'm going to be doing in 5 years from now. I mean, all I can answer that is I hope I'm still alive. Now, let's look at inflation. A controlled inflation at 3, 4, 5% is very positive. Now, you know, I see you're not married, but I'm sure you must have 3 or 4 or 5 girlfriends. And I mean, I'm sure they're looking at the window if there's Jimmy Choo shoes or handbags. Well, if they know it's going to be the same price this month, next month, June, are you going to have anybody getting up at 4 o'clock in the morning to stand into the queue? And that's what it is. A little bit of inflation is very positive because then people will start to buy.
Encourage people to spend now.
Exactly right, okay? But the simple fact is, because of the global economy, we will never have inflation like we had in those days. So the simple fact is, all right, let's just say if OPEC decided to turn off the pumps again like they did in 74/79. All right, so the U.S. does more fracking, okay? Then all of a sudden we get oil from Iran, from Libya, and even Venezuela decides to be a good friend. There's too much of a global. Looking back just what 2 or 3 years ago, excuse me, when we had the problem with wheat, and we had the heat wave in Australia, we had droughts in Russia, we had a drought in the United States. Well, all of a sudden, there was upward pressure. But I mean, look at 6, 7 years ago when we had a problem with the wheat. Okay, we had tortilla riots in Mexico. Okay, there was a lasagna riot in Italy. Now it's just a situation. China says, okay, well, we just do another 1 billion acres of wheat. So there's too much of a global economy. Okay, and also with inflation. I mean, right now we're talking. I think one of the think tanks, like 2016. Okay, there's going to be a new country around in reference to oil. It's going to be called Saudi America. Okay, whether it be shale gas, with fracking, etc., etc. And now the situation with Iran coming on stream, with Libya coming back. You know, I mean, if you've been looking at the oil prices are still much too high. I mean, it's talking about, if all of this starts to happen, okay, in 2014, 2015, I mean, we could lose, $15 to $18 off the price of Brent, okay? If it does that, what's it going to do to WTI?
So you're playing down the importance of inflation figures?
Yes. I mean, I have to go back to what Magic Mario said last week. I don't care what anybody else says. He hinted, if you read between the lines. I mean, there is a deflation worry, okay, in the Eurozone. And as you just mentioned, I mean, since the Eurozone happened, last month was the lowest on record, okay? And it's only going one way, and it's going to be going lower, okay?
Great, okay, well, I think that's just about it for this week.
I'm just getting started.
Just getting started. Well, unless you want to shed one more piece of light on anything you wish for the week.
But I think one thing, is the simple fact is we've seen with the market, whether it be the dollar, whether it be the equity markets, the market was shocked last Friday's non-farm payroll, but they do realize this was, quote, weather-related, and it'll work through much quicker, okay?
But it's very difficult to quantify how much of that was weather-related. So can we almost disregard that number?
Yeah, I think most people have.
Most people have.
Most people, if you look at the regression theory, okay, ADP versus non-farm payrolls, it should have come in, okay, using regression, and I say theory, okay, it should have come in at 208,000, and that was basically the number, okay. I know the Bloomberg number was 197, but after the ADP number the day before, everybody was hitting like 20 to 30,000 more people. And remember, another thing that people have to remember, every Thursday we get jobless claims, okay? These are people, this is not a seasonally adjusted number. These are people that sign on, okay? Let's just look here in the UK, and the simple fact is if you were living in parts of Kent or Cornwall or Devon, and you couldn't get out of your house, there was no way you could have signed on. So therefore, it would have shown that jobless claims would have dropped dramatically, okay? And also the simple fact is you had a much higher seasonal factor. And most people now are taking out the seasonal factor with Christmas because of online.com, okay? And what are they talking, like 100 billion here in the UK now can start being done online. So if you're doing it online, Waitrose, Tesco's, et cetera, are not going to have to hire. And you saw that in the States, okay, where the market was assuming, okay, that there would be a layoff, okay? Well, there wasn't much of a layoff, but the key here was the weather-related jobless claims number, and you can start to see that back up in, as I said, using regression theory. And I'll explain that to you next week.
So that's Bill's last thing of the day to say that you should ignore last week's non-farm payroll number. Well, great. Thank you very much, Bill.
Thank you.